Loss reduction. Although stringent loss prevention efforts can reduce the frequency of losses, some losses will inevitably occur. Thus, the second objective of loss control is to reduce the severity of a loss after it occurs. For example, a warehouse can install a sprinkler system so that a fire is promptly extinguished, thereby reducing the loss. Highly flammable materials can be stored in a separate area to confine a possible fire to that area. A plant can be constructed with fire resistant material to minimize a loss, and fire doors and firewalls can be used to prevent a fire from spreading. Loss control ideal method for handling risk. From the viewpoint of society, loss control is the ideal method for handling risk. This is true for two reasons. First, the indirect cost of losses may be large, and in some instances, they can easily exceed the direct cost. For example, a worker may be injured on the job in addition to being responsible for the worker's medical expenses and a certain percentage of earnings. Direct cost the firm may also incur. Sizable. Indirect cost a machine may be damaged and must be repaired. The assembly line may have to be shut down. Costs are incurred in training a new worker to replace the injured worker, and a contract may be cancelled because goods are not shipped on time. By preventing the loss from occurring, both indirect costs and direct costs are reduced. Second, the social cost of losses must also be considered. For example, assume that the worker in the preceding example dies from the accident. Substantial social costs are incurred because of the death. Society is deprived forever of the goods and services that the deceased worker could have produced, and financial insecurity. And the worker may personally experience great pain and suffering before he or she finally dies. In short, these social costs can be reduced through an effective loss control program. Insurance and reinsurance as a risk transfer techniques. Insurance and reinsurance are both forms of financial protection which are used to guard against the risk of losses. Losses are guarded against by transferring the risk to another party through the payment of an insurance premium as an incentive for bearing the risk. Insurance and reinsurance are similar in concept, even though they are quite different to each other in terms of how they are used. Insurance. Insurance is a more commonly known concept that describes the act of guarding against risk. An insured is the party who will seek to obtain an insurance policy, while the insurer is the party that shares the risk for a paid price called an insurance premium. The insurers can easily obtain an insurance policy for a number of risks. The most common types of insurance policy taken out is a vehicle auto insurance policy, as this is mandated by law in many countries. Other policies include homeowners insurance, renters insurance, medical insurance, life insurance, liability insurance, and etc. The insured who takes out a vehicle insurance will specify the losses against which he wishes to be insured. This may include repairs to the vehicle. In case of an accident, damage to the party who is injured, payment for a rented vehicle until such time the insured's vehicle is fixed.